Hello and welcome to Moneylife. This is Sucheta Dalal. This week, let's talk about an issue that affects all of us, which is mis-selling of financial products by banks. It affects all of us. We are hard-sold products. And why are we talking about it now, after nearly 20 years? Because the RBI has finally come up with draft mandates. Remember, draft, okay, which seem to offer a turning point in how banks behave. Let's look at the story behind it. So let's start at the beginning. How long does it take for a regulator, in this case the Reserve Bank of India, to respond to bad banking practices or financial practices under its regulatory purview? The shocking answer is nearly 20 years. Yes, even the RBI may deny it, but selling of toxic products started around 2005 6 or even earlier. That's when so many people got saw their savings decimated with toxic unit linked insurance plans, right? And then there's been tinkering and tinkering through 20 years, and I'm going to tell you the story because it's important and why you have to look at how to respond to the fact that the Reserve Bank of India on 11th February released what it calls Responsible Business Conduct Amendment Directions. This is a really comprehensive framework designed to dismantle predatory mis-selling, and this has dominated banks for decades, like I said. It could transform how banks behave with us, the customers, provided the draft is passed into formal mandates as it is, without dilution and without change. Now, on the face of it, there is no connection between what I'm going to tell you next, which is the long ignored mis-selling by banks, and the issue of digital arrests. But there is a connection because a series of blistering indictments by the Supreme Court over multiple hearings, I believe, are responsible for this change coming out the way it has at this point of time. So the Supreme Court is hearing a suo motu case on digital arrest, and it is furious. The things that the Supreme Court has said about banks and their role is quite amazing. More about that later. On 7th February, the Supreme Court, more importantly, a bench headed by Chief Justice Suryakant, had confronted the government and the RBI over 58,000 crore that has been looted from hapless individuals through digital arrests. And digital arrests are like a 2-3 year phenomenon, right? Doesn't go back 20 years. What did it say? It noted that banks have become platforms for crime transmission, that bank officials are hand in glove with the accused. It directed the union government to formally adopt and implement RBI's standard operating procedures, which had been presented to the court around the 2nd of February. It wants a time bound interagency framework to prevent and respond to cybercrime, and it has ordered a pan India CBI investigation. It further said that RBI must go beyond advisories and have enforceable measures with potential incentives and penalties for compliance. This is as far as digital arrest is concerned. What does it have to do with mis-selling? Because just 2 days later, you have these draft guidelines. And I believe that the anger of the Supreme Court, the fact that it says the buck stops with banks and naturally its regulator, has finally prompted RBI to consider binding regulations with punitive consequences, okay, for an issue that is 2 decades old. Why am I saying it with such confidence that it's 2 decades old? Because you know that banks earn fat fees and commissions from selling toxic products. I've already talked about ULIPs, leverage speculation. They were at one time hawking dodgy art schemes which collapsed, dumping you with unnecessary credit cards, encouraging churning of mutual funds. Then the market regulator stepped into it and stopped. Otherwise, the wealth of wealth management customers was being decimated. And Moneylife has reported this all through this period. We started in 2006 and we have been at it literally from the second issue of Moneylife. Now, RBI has invariably responded to all this. Not that it didn't know, it knew, but its response has been tinkering with regulations, not going all the way as it has in the draft, and its governors and deputy governors making fiery speeches when they address bankers. Bankers listen to the speech and don't care. RBI also forgets about the speech and doesn't do anything. As far back as 2010, when we started Moneylife Foundation, which is a not for profit advocacy and financial literacy initiative, we used to openly warn members about their friendly relationship managers. We said, beware of them because they will do anything to meet perverse incentive targets. They don't care about you. In 2013, we went a step further and submitted a comprehensive memorandum. You can look at it, it's on the Moneylife Foundation website, where we not only detailed mis-selling with examples, but we asked RBI, we pleaded with them to come up with binding regulations to protect consumers of banks. No significant action was taken. In fact, rampant mis-selling continues even today. Just last week, somebody reported a rare case where it got escalated to the finance ministry. Sometimes it gets escalated to the governor. When that happens, that case is resolved. What about the thousands that don't? We always say few people discover money life and at least see a way forward. Not everybody does. The RBI's top brass is fully aware of the extent of the problem. They have issued empty threats and warnings against aggressive, target driven mis-selling in their public speeches, but tinkering and advisories, directives do not help without punishments and SOPs. This is what we have said repeatedly. In 2011, a response was to set up a Damodaran Committee on Customer Services. 2011, mind you. I wrote an article even then where I said this whole issue of mis-selling has been ignored by the Damodaran Committee. In fact, I've critiqued a lot more, and there is a link over here. In 2023, RBI set up another committee on customer services, this time under its own deputy governor, Mr. Kanungo, which came up with an excellent report, addressed all the pain points, KYC, harassment, lockers, what have you. We made a presentation even then. Believe it or not, we were very happy with the report, but many of its recommendations have been diluted, ignored, or are being implemented in drips and drabs over a period of time. 2023 is when the report was presented. It started more than a year earlier. And even today, it's not complete. This reluctance of regulators to act naturally emboldens banks because the banks have the attention of the regulator. In fact, that is why the term banksters was coined. Because when your bank, which is in a fiduciary role of a trustee, as the Supreme Court is now pointing out, that cheats you, then it's nothing but a bankster. By 2017, bankers themselves were fed up of the pressure. So the All India Bank Officers Confederation and its then Secretary General D.T. Franco wrote a scathing letter to the chairman of the Insurance Regulatory and Development Authority, warning about the vicious cycle of foul practices. It's a detailed letter, again available on our website. Nothing happened for a year. In 2018, T.T. Franco wrote again, and he noted that bank staff was being incentivized with everything from cash rewards to foreign junkets, causing them to do forced bundling. If you have ever taken a loan, you know what it is. You take a loan, they attach a certain insurance policy to it. Happens with car loans, happens with housing loans. Which is the insurance policy? The one that gives the banks the highest commission. In fact, Mr. Franco noted, on behalf of the officers' union, mind you, with utter dismay that regulators had remained mute spectators to the cheating of customers. Again, all this is in the public domain. Now, from mis-selling, we have moved to digital dacoity. So while the regulator has not acted hard enough, naturally, the next step is AI, the technology, and literally digital dacoity. This time, the RBI quickly prescribed SOPs, including placing temporary debit holds on accounts when there are suspicious transactions, especially linked to cyber enabled fraud. This has been rolled out, the court has noted it, but recent, after the court was really angry. RBI also went and claimed in the court that it has now begun to use AI to detect mule accounts. Excuse me? They have been aware about mule accounts without the need of AI before AI came into existence. In fact, in 2016, I think we were the only ones who made much of the speech by Deputy Governor S.S. Mundra because he warned that primitive monitoring allowed criminals to recruit money mules to launder the proceeds of phishing and identity theft. He particularly talked about Jandhan accounts because these were people who were outside the system. They had been quickly enrolled. They are by and large poor people, and they were tempted to allow their accounts to be hired. Now they are suffering. They are the ones who are called money mules to move money through their accounts. Over a period of time, while you and I have had our bank accounts frozen, even though you have a relationship with the bank for 20 odd years, because of KYC documents, and they haven't even told you that your KYC is up for updation, the proliferation of these mule accounts and misuse of accounts has been so rampant that in some instances of digital fraud, the cops have found that money has moved through hundreds of accounts to hide the trail. How do these hundreds of accounts with dodgy KYC exist? Do bankers not know? Because it has to be happening regularly, or the accounts have to be closed, new accounts have to be opened. The buck stops with the banks. It's impossible that they don't know. The fact is that they don't care. And why haven't they cared? Because there is no need for them to care. There is no responsibility, there is no punishment. And all this has changed because the Supreme Court has now begun to question. It is the apex court. And you can't appeal anymore, you can't lobby anymore if the apex court sounds angry, right? So the apex court said if a pensioner who usually withdraws 10,000 to 20,000 suddenly transfers 50 lakh, 70 lakh, 1 crore, how is it that the so called artificial intelligence does not raise an alarm? Courts have made it clear that banks are trustees of customer funds, the buck stops with them, and this pressure appears to be working not just for digital arrest or digital fraud, but thankfully for misselling in general. Now let's look at what the RBI said and figure out, is this going to be a game changer or more of the same? So I believe it can be a game changer if properly implemented, because the first time RBI is going beyond directives, advisories to prohibitory mandates. So there are 4 points on which the success of this draft will depend. First, strict implementation of the absolute ban on incentives to bankers from third parties, sister entities, all these cash and foreign trips, and also to the entity itself. This is not spelled out. So if the bank gets incentives because of tying up with a certain mutual fund, you may stop the incentives to an officer, but it has to go to the bank itself. So in fact, it has to be tightened, right? So individual incentives will work if banks also are stopped from aggressive fee-based income targets. This has to happen. Second, the recognition that banks have been using deceptive interfaces to trick customers into dark patterns and basket sneaking. All this sounds like gobbledygook. What it means is pre-select and bundle certain products into a basket and force it, or show certain things as being more attractive than they are, or not allow you to even look at your account balance unless you have looked at their credit card offers, or home loans or auto loans, all kinds of things. These are dark patterns which even the Ministry of Consumer Affairs is looking at more seriously. But RBI's draft specifically identifies and bans these. This is in line with global consumer protection standards, nothing new about India doing something out of the box. Third reform is to move to a 100% refund and compensation model if the customer establishes misselling through forced bundling and misleading information. So financial risk moves from a bad sale from the victim to the institution. Another good measure has to be implemented correctly. The fourth, a 30-day cooling off period. They used to ensure that you never got your policies or your credit card details before. Now it's not possible. It's all online, has to be online. So the RBI has gone a step further and said an independent channel has to verify whether the customer has understood the risks and products details sold. If they sound confused or dissatisfied, the sale has to be reversed without imposing a penalty on the buyer. So if all these rules are converted into binding mandates, indeed a huge move forward. But remember, who's going to be affected? It's going to mean a loss of business and profits to banks, mutual funds, insurers. They have surely begun to lobby hard already. And in the past, our experiences, 20 years doesn't pass for nothing. It's because they succeed in their lobbying. You have to raise your voice because you in numbers are much larger than these powerful entities, but you keep quiet as a customer. So if our voice is higher, it will matter. And some regulators have made it different. For instance, look at how it works. Bank relationship managers and banks can sell you any product apparently curated by the bank, but may be bad for you, does not come under SEBI's financial advisor guidelines rules, which are so onerous and strict that people have been giving up an acquired license. But they are out of it. All these are things that RBI has to look at and wake up to. Otherwise, the draft guidelines are not going to work. And I'm telling you that bankers and mutual funds and insurers already be lobbying to dilute them. The another issue is who's going to enforce these rules. So you have an RBI ombudsman, but its pecuniary jurisdiction is only 20 lakhs and it can impose penalties of 1 lakh. So it has to be RBI's Department of Regulation and Supervision. Neither the ombudsman nor the RBI personally has a great record. In fact, the ombudsman keeps complaining, even with just 20 lakhs as a cap. We're not talking about crores of rupees and entire savings going away. But ombudsman often closes complaints without listening to the customer because they're influenced by the bank, and they sometimes even stop you from appealing. In fact, the number of times they have awarded, this is a 2019 amendment where they could give you compensation, but in less than 1% of hundreds of thousands of complaints, they have ordered compensation. So it's been a free for all. Banks have enjoyed lots of liberty to missell to you, and RBI has done nothing for a long time until now. These guidelines, in fact, sound like an admission of a decade plus of regulatory lapses. The difference now is that the Supreme Court has noted its inaction on one set of things, can be transmitted to another, it is impatient, and it is clear that banks have to be held accountable for failure in digital fraud. So, why not for mis-selling of financial products? Some people are going to take it up over there and ask, isn't there an obvious comparison? Countless of individuals have seen their hard-earned savings erode due to mis-selling of financial products also, but not with the same sudden brutality of digital arrests. This is really huge in a small period of time because people are scared. People are scared that they will be wrongly targeted and imprisoned for having done nothing wrong, and that's why they fall for this. In both instances, one thing is clear: banks are the trustees of your funds. They are not just keeping it without any responsibility. They have to be held accountable and up to a certain standard. If the shocking nature of digital arrest scams stirred the Supreme Court into demanding stricter action, one hopes it will lead broader reform. Clear articulation of the duties and accountability of banks and regulators alike should lead to enforceable mandates for mis-selling rather than pious directives. It depends on you whether you also wake up, point it out, tag the RBI on social media, and say we want these draft guidelines to be implemented as is, or in fact tighten further. It shouldn't be just bank officers. Even the banks should not be allowed to missell to you. If you agree, please share this so that a lot more people can become aware and act on it. Thank you.